gold was down 3%. The gold stocks, the GDX, was down 6.5% on the week, and the GDXJ was down 7%. Why? Right? It makes no sense. Yes, I know gold went down, but so what? It went down to 3,300. That is a very high price for gold relative to all of the earnings expectations for these gold stocks. Nobody that covers gold last year expected gold to be at 3,300. In fact, when gold got to 2,000 a little over a year ago, nobody thought it can go any higher. They all thought that was the top. And here we are more than 50% higher. And stocks like Newmont and Barrick are lower than they were back then when gold was at 2,000. Now there are some stocks that are higher, but the two biggest stocks are actually lower. So why should they even go down at all? They should just be going up every day, regardless of where gold is. Who cares? I mean, if gold's bopping around above 3,000, that is a phenomenal price. In fact, we got the Newmont earnings. They were the first major gold company to come out with earnings. We got those earnings after the market closed on Thursday, I believe. And so Newmont beat its earnings estimate by 42% above what analysts thought they were going to earn. That is a massive beat. Their year-over-year revenue in the quarter was higher than the prior year's revenue by 25%. That is a huge increase in revenue in a year. But their profits, quarter over quarter, were up 127%. I mean, how many companies in the S&P 500, Newmont's the only gold company there, are going to report year-over-year profits up 127%, a crazy amount. You would think, oh, this stock's going to be way up because, gold was up like $50 that day too. It was a day that gold happened to be up. So gold's up $50, the earnings come out, and the stock's up like 2% that after hours. If the price of gold went to 10,000 tomorrow, right, and then it went down to 9,000, right? Would these stocks really have to get killed, especially if they barely moved up on the move to 10,000, right? I mean, once you have this kind of breakout, which is what we've had in gold. See, what people don't really get is that for years and years and years, gold has been underpriced and underowned, right? Investors don't own it. Central banks have a very small amount. If you look historically, even though they've been buying a lot of gold, if you look at the gold that central banks own as a percentage of their total reserves, it's still historically low. It's not as low as it was, but it's still below historical average. That's because the currency reserves, mainly US dollars, have exploded. And so central banks have underowned gold. Retail investors have completely underowned it, and institutional investors. So the private sector has underinvested in gold, and so has central bank. And so gold prices have been too low. Meanwhile, the cost of mining gold keeps going up because of inflation. Now, if gold was purchased the way it should have been by investors and central banks, given how much inflation was being created and all the dollars in our trade deficits, the price of gold should have been a lot higher, but it wasn't. And the biggest victims of that were the gold mining stocks because they had to deal with the inflationary impact on costs without getting the full impact on the price of gold. Well, that's now changed. Ever since, I think, early 2024, gold prices are now far outstripping the cost of mining. But Wall Street hasn't figured that out yet. They haven't re-rated these stocks. So at some point, they need to be massively re-rated at much, much higher prices, even if gold goes down hundreds of dollars, because it's already moved up so much beyond the cost of mining it. Plus, this breakout means that gold is going up. 34.90 that we got on Monday, that is not the record high for gold for all of eternity, not even probably for the rest of the month. Gold prices are going above 3,500. They're going to go above 4,000. They're going to go above 5,000. So what should these gold stocks be worth? Because the cost of mining is not going to go up anywhere near the same percentage. It will go up. Inflation is going to drive the cost of everything up. But as investors realize how bad inflation is going to be and how long it's going to be here, they're going to keep bidding up the price of gold.
Gold is finally waking people up, whether they realize it or not. The price action isn't just a blip. It's a blaring siren. I've been in this business over 30 years, and I've never seen gold act like this. 3 times in just the past few months, we've seen $100 daily moves. That used to be unthinkable. Gold was the slow and steady tortoise, right? But now it's morphing into something far more aggressive, and it's still early. What's so remarkable isn't just that gold is going up, but that nobody seems to care. The mainstream media is out to lunch. They're talking about AI stocks, crypto pumps, the next hot ETF, but gold, crickets. You have to really dig to even find someone acknowledging what's happening in the monetary system. But here's the thing. Gold doesn't need a press release to do its job. It doesn't care if people are watching. It simply reflects the truth about the declining purchasing power of fiat money, the slow-motion default of governments, and the fact that central banks around the world are trapped. And I mean trapped with a capital T. Let's go back in time for a second. Remember the housing bubble? I was screaming from the rooftops in 2005, 2006. I could see it all. Insane leverage, mispriced risk, systemic fraud, and I was ridiculed for it. They laughed. They called me doctor. Doom. But guess what? That bubble popped, and the system nearly collapsed. The same people who laughed at me then are ignoring the exact same signs now, except this time, it's bigger, much bigger. The bubble isn't in housing, it's in everything. In government bonds, in fiat currencies, in sovereign credit. And gold is the pin. You don't need to be a PhD in economics to understand what's going on. Just open your eyes. The United States is running trillion-dollar deficits with no end in sight. Entitlement spending is exploding. Interest expense alone is now one of the largest line items in the entire federal budget. That's right. The interest on the debt, just the interest, is now bigger than the defense budget. And yet we're supposed to believe this is sustainable. The only thing keeping this machine running is the Federal Reserve. And even that's coming apart. They tried to raise rates, they tried to shrink the balance sheet, and now they're stuck. They can't normalize anything without blowing up the whole system, so what are they going to do? They'll go back to what they always do. Print more money, QE infinity, yield curve control, bailouts disguised as stimulus. You name it, they'll try it. But this time it's different, because this time the world isn't going to go along with it. Look at the dollar. It's weakening against everything, not just gold, but against the Swiss franc, the euro, even the yen. That should tell you everything. It's not just about gold anymore. It's about the loss of confidence in U.S. leadership, in U.S. debt, and in the illusion that we can print prosperity without consequence. And yet, what are the investment professionals doing? They're still crowding into tech stocks, still chasing Bitcoin, still ignoring the one asset that has withstood every currency crisis in human history, gold. And not just gold. Let's talk about the miners. I've said it before and I'll say it again. The mining stocks are the most undervalued sector in the world. And I'm not talking about some obscure penny stock on the Vancouver Exchange. I'm talking about Newmont, Barrick, the big boys. These are companies that are generating cash hand over fist at current gold prices. Gold at $3,300 is already well above their break-even cost. And the margins they're sitting on right now are some of the best they've had in years. Newmont, for example, just crushed earnings. I'm talking triple-digit profit growth. Revenue up 25%, earnings up over 120%. And yet the stock barely moved. That's not rational. That's not a market that's functioning properly. That's a market that has completely mispriced risk and reward. You know what that is? Opportunity. The kind of opportunity that doesn't come around often. And when sentiment finally shifts, when the money starts rotating out of the overbought growth darlings and into real assets, these miners are going to explode. Look, I get it. Nobody wants to talk about gold stocks. They're boring. They've underperformed for a decade. But that's exactly why you should be looking at them now. Because markets move in cycles. And this cycle has turned. The breakout in gold above $2,100 was the signal. The move past $3,000 was the confirmation. And what you're seeing now is the re-rating just beginning. And don't think this is just about inflation, by the way. Inflation is part of the story, sure. But this is about something deeper. This is about the end of the post-Bretton Woods system, the end of U.S. monetary dominance. Central banks know it. Why do you think they're buying more gold now than they have in decades? They're not buying Bitcoin. They're not buying Tesla stock. They're buying the one thing they know will still be standing when this system comes apart. And it's not just China and Russia. Look at Poland. Look at Turkey. Look at Brazil. These countries are accumulating gold at a record pace. The US, we're going the other way, selling treasuries, running up deficits, replacing gold with IOUs. And the funny thing is, gold is even in our balance sheet. Go look it up. It's sitting there in the gold revaluation account. The Fed knows what it's doing. It's just not telling you.
I think what happened, especially looking at what was happening on Monday night, because all of those trends continued on Monday night. In fact, gold hit a new all-time record high. It was within $10 of 3,500. That's how much gold had gone up. It was above 3,490. Now, you may expect some profit taking at a round number like that. We were almost halfway between 3,000 and 4,000. And we had only just breached 3,000 like weeks ago. And now we're almost halfway to 4,000. But the dollar was getting killed. The euro was above 115. There was a 97 handle on the dollar index. Stock futures were selling off. Bonds were under pressure. They didn't make new lows, but they were on their way. And so I think looking at what was happening in the markets, the advisors to Donald Trump got to him and said, we need to do some damage control. You need to walk back that Truth Social post. And so on Tuesday morning, early in the morning, Donald Trump said, hey, of course I'm not going to fire Trump, Powell. He's going to be there until the end of his term, or I'm not going to do anything with Powell. And the market had a huge rally on that. And, it's hard for me to believe with all of the market savvy people that are in the Trump administration. A lot of people have come, from Wall Street, right, that are there. And they know that the markets are going to move big on comments that come out of the White House, even though nothing actually happened, right? Just somebody saying something, not actually doing anything, but just a post on Truth Social can cause massive swings in the stock markets, in the currency markets, in the crypto market. I'm sure there are people in the Trump administration that are trading off of this. How could they not be, given the size of the moves and the fact that, actual news. I don't even know if it's insider trading because there's nothing actually happening. These are just comments that really don't mean anything. And in fact, I think the comments are specifically designed to impact the market. I think Donald Trump's comment about Powell was, oh my God, the market's getting killed. I need to turn it around. So let me reassure the markets that, there's still Fed independence, because that was what people were worried about, that, this means that we're not going to have an independent Fed. We're going to have a Fed controlled by the White House, and that's going to be bad, as if, it hasn't been bad all along. But I agree that the more you politicize the central bank, the worse it is, because all the political pressure is for easy money. That's why it's ridiculous for Donald Trump to be accusing Powell of being political, in that Powell is not cutting rate, because that's political. So the fact that he's holding tight is more of an independent move, because the political pressure is to cut. Now, he should actually be raising rate. And I think the fact that he's not raising rates is because of political pressure.
IG gold, and they're going to be looking for leverage. And where are they going to get that leverage? Not from buying more physical coins, not from the ETFs. They're going to get it from the mining stocks. That's where the leverage is, and once that realization hits, once the psychology shifts, you'll start to see capital pour into the sector like a dam broke. Right now, these gold mining stocks are trading like gold is at $1,800 an ounce. That's how mispriced they are. The market still hasn't repriced this sector based on reality. What does Wall Street think? That this gold price surge is just a fluke? A glitch in the matrix? No, it's the signal, not the noise. But here's the opportunity. This is why the contrarians always make the real money. Because they understand when the herd is asleep, you load up before the stampede. Now let's take a closer look at some of these miners. I already mentioned Newmont and their massive earnings beat. Think about that. 127% year-over-year earnings growth in this environment, with costs still elevated from supply chain disruptions, higher fuel prices, rising labor costs, and environmental regulations. So if they're still pulling off triple-digit profit growth under those conditions, imagine what's coming when gold hits $3,800, $4,000, or beyond. And let's not forget Barrick, which is still languishing below levels it hit when gold was $2,000. That's insane. You've got a company that's streamlined, improved operational efficiency, lowered its debt, and even increased dividends. But it's trading like gold is on life support. This is not just mispricing. It's a gross market inefficiency that has been allowed to exist because the Wall Street machine doesn't understand gold. They don't understand sound money. They're still too busy hyping up meme stocks, AI chips, and crypto junk coins. Let me just be blunt here. If you are invested in Nvidia and you think that stock is going to protect you from the collapse of the dollar, from the collapse of US creditworthiness, and from the collapse of fiat confidence, good luck. When this financial system resets, and that's exactly where we're headed, there's only one insurance policy, and it's been the same for 5,000 years. Gold. And if you want to supercharge that insurance policy, you buy the companies that own the most gold in the ground, that produce it profitably, and that have been systematically ignored by this casino of a stock market. Now let's talk psychology again, because this is where markets really change, on sentiment. Once the gold price broke $3,000, the game changed. That was the psychological line in the sand. And yes, there was some selling, some consolidation, some pullbacks, but overall you're seeing strength. That's not just price action, that's global confidence being rebuilt in real assets. And here's another thing. Gold isn't going up because of geopolitical risk. That's the lazy media narrative. It's not because of tariffs or because of war in the Middle East or China and Taiwan. It's because fiat currencies around the world are imploding in slow motion, and the only people who haven't figured it out yet are the ones watching CNN and trusting the Fed. Take the Swiss franc. It's one of the best performing currencies this year, up 11%, and it's barely a whisper in the media. Do you know why? Because nobody wants to admit that the so-called cleanest dirty shirt isn't the dollar anymore. That's been the excuse for years. Oh, sure, the dollar's bad, but everything else is worse. Well, newsflash, there are plenty of currencies doing better than the dollar this year, including the yen, which everyone had given up for dead. And don't even get me started on Bitcoin. The people who were calling it digital gold now want to pretend it's a tech stock. It's a joke. Now think ahead. Think about when inflation data starts coming in hot again. When oil breaks $100, when food prices spike again, and when the Fed, desperate to keep this house of cards from collapsing, starts hinting at more QE, at rate cuts, at yield curve control. You know what's going to happen? Gold's going to go vertical, and this time it won't be a speculative rally, it'll be a global repricing of risk. And the miners? They'll go absolutely parabolic. You know what else happens during that repricing? Confidence dies. Confidence in the Fed, in the dollar, in treasuries, in the idea that a group of unelected bureaucrats can centrally plan the most important price in the world. Interest rates. That confidence has been misplaced for decades, and it's now unraveling in real time. And by the way, don't wait for CNBC or Bloomberg to tell you this. By the time they figure it out, the GDX will have already doubled. That's how this works. The mainstream never leads. They follow. And when they finally start featuring gold mining CEOs on their morning panels, that's when you take profits, not before. Let's talk more about the mining sector specifically. The juniors, the GDXJ. These are the companies that nobody wants right now. And yet in every gold bull market, these are the names that go up 5x, 10x, sometimes even 20x. Why? Because they go from zero to hero when the capital rotation happens. They go from being ignored to being bought out. Every major miner out there knows their reserves are falling. They need new discoveries. They need ounces in the ground. They're not going to drill their way out. They're going to buy their way out. And they're going to overpay because by then it's going to be a frenzy. Now I know some of you are thinking, Peter, what about silver? Oh, I've got news for you. Silver's sleeping now, but when it wakes up, it's going to make gold look like it was standing still. The gold to silver ratio is still above 90. That's historically insane. That's your signal. And when silver wakes up, and it will, it's going to slingshot. The mining stocks with silver exposure are going to go absolutely berserk. And if you own the right juniors with exposure to both gold and silver, that's where the real fireworks will be. Let me wrap this up by saying this. We are at the early stages of a historic repricing of real assets versus paper promises. Bonds are toast. Fiat currencies are toast. Equities, especially tech stocks priced for perfection in a world of infinite liquidity, are on borrowed time. The rotation into tangible wealth, into gold, silver, and the companies that produce them, is not only coming, it's already started. The mainstream just hasn't noticed yet, but you have the opportunity to position yourself ahead of that awareness. So whether you're holding bullion, ETFs, or miners, understand this is a long-term shift. Don't get shaken out by the noise. Gold up 3%, down 2%, who cares? That's the market trying to steal your position. The real move is coming, and when it does, you'll wish you had bought more when the herd was still sleeping. The great wealth transfer is underway, from digital illusions back to real money. Don't be the last one to realize it.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.